Okay, all right. Well, once again, thanks a lot, everybody. So we really have a wide range of different people here, from sophisticated, longtime investors and real estate players to some investors who are more new to the real estate investment game. And so we'll try and cover as much as we can to make it meaningful and valuable and as much information to everybody. And then the important thing to also note is that this is the first of a series, and so every single kind of item that we're going to discuss here, we could really do a whole webinar in and of its own just on that item. And so we're going to try and kind of give an overview, and then there will be follow-up to each one of these subjects. So we're excited to just go ahead. So I'm Daniel Farber, the CEO of HLC Equity. I've been with the firm for a very long time, but in an executive role for over 10 years. It's just great to be here and to be with the team members. And really, I view our company as a people-driven company. Really, the people in our team is what make the company. And so I'm excited to have some of our other investment team here. So I'll let them introduce themselves. So please, David.
Good afternoon, everyone. I'm David Molitor. I'm head of operations for HLC Equity. In my role, I kind of oversee property operations. I'm involved in asset management and project management for the company. Prior to joining HLC, I worked for McKinney Properties, another Pittsburgh-based company, and there I had roles in both property management and acquisitions. Caesar?
Thanks, Dave. Good afternoon, everyone. My name is Nguyen. I'm a director of acquisition at HLC. I've been in the real estate industry for almost a decade now. I started out my career in investment banking and private equity in real estate. And then my last firm was Common Living. I was the head of East Coast real estate and helped them expand their portfolio and bring out an entire new, essentially, asset class in multifamily. And I'm excited to join HLC almost a year ago at this point. To transition, to help bring some of that skill set to help HLC expand our capability over the next decade.
Great, thanks a lot. And Caesar, you may have joined relative to the firm and the firm's history relatively recently, but I think that we've been discussing it for far more than a year. I can't even count how many. So so we're really happy to have you and to have Dave and everybody else on the team. Very good. So just a quick run through the agenda. Like I said, we're going to be covering a lot of items, and it's really important for everybody to know that there will be a Q&A opportunity at the end. And so we're excited to open that up and to allow everybody to ask any questions that they may have. So real quickly, we're going to go about HLC Equity, just a little bit of the history and where we are today, building towards legacy, a multi-generational firm, and some of the values that have taken us, where we are to today. Some innovation and some of the innovative business models that we're implementing within our own real estate operations today, and then we'll run through some market analysis, and we'll feature also one of our current investment opportunities, just to do a quick overview of the opportunity, and then just talk a little bit about investments going into 2022 and beyond, and then we'll do the Q&A after that. So when we think about legacy, I mean, obviously that's a very that's a big word. There's a lot that goes into it, and and it can mean a lot. It can mean everybody. It's values. It's what somebody wants to leave behind. It's a whole lot. We're talking today, we'll focus mainly on the business aspect of it, because obviously everybody has their own kind of set of traditions and values that they want to transfer and they want their legacy to be. But we'll kind of gear in terms of the business side of the legacy. But when we think about it, between these assets, values, and tradition, which really create the legacy, there's many tactics to get there and many kind of like core values to get there. But there's one main one that I think really encapsulates a lot of what we do, and that's long-term thinking. And that goes from a business standpoint, being in the business for a long time as a firm for several decades, and thinking not just, okay, what's going to make sense for us and our partners today, but what's going to make sense for us in 10 years, 20 years, 30 years, 40 years. And then there's there's, that's also translates into our investment thesis, where our overall approach is to buy assets that we believe will be strong assets to own for a very long time. That doesn't, sometimes our holding periods are shorter, but we always want to own assets that we know will be strong, solid assets that can be held for a very long time. So if we think about kind of HLC and in terms of a flywheel and in the progression of the firm, when we talk about multi-generational. So traditionally our firm was really based on, the founder of the firm, Herman Lipsitz, who did well in business and basically would buy some real estate and gathered a portfolio of holdings. And those holdings, basically were a mixture of both multifamily and also net lease assets, which are essentially commercial properties that are on a long-term lease where there's very little management involved, to shopping centers, which are rather management intensive. And that it was really just kind of leveraging their own internal, business capital, acquiring assets that made sense to acquire from a return and a kind of growth standpoint, and then managing those assets effectively, and then realizing the growth when the time was right and reinvesting. And I think that something that's important to mention here is that realizing growth didn't necessarily mean always selling. It could have meant refinancing. Frequently it meant selling, but then exchanging into other properties. And, in order to make, the real estate holdings more tax efficient. But this is really kind of where the company was for several decades. If we think about where we are currently, where the kind of like next generation has built a different flywheel and kind of like a natural progression of the firm, where we acquire opportunities that align with the internal goals of the firm, but also with investors. So when I bring in investors now, like I said, traditionally, it was primarily, investing on the principal's account. And over the last several years, we've built out the proper infrastructure for investor relations in order to be stewards of other people's capital, while also obviously investing in these deals, and many times being the largest check in deals, always being the lead investor in deals, and really taking on a good bit of the risk up front in order to get the deals, but then opening it up for other investors to invest with us of all sizes, from private high net worth individuals, accredited investors, to large private equity groups and wealth management groups and everything in between. So a lot of that goes into the executing and improvement of the properties. And Dave, you have any thoughts on that? I want to make this a little bit more inclusive. So please, this is where Dave steps in.
Sure. Yeah, no problem. Yeah. So, as we've evolved, Daniel kind of touched on the evolution of the company. One of the, in our approach to investments and adding value, a lot of our underwritings have included some sort of value add component in the past and currently, whether they're kind of the traditional value add, which would be, kind of updating or renovating common areas and units, or as we'll get into, in more detail, the more innovative value adds or non-traditional value adds that we're working on. But along those lines, we've kind of built a team of experienced people in property management and engineering, in project management, to kind of execute those plans. And we've done so at a number of properties. In fact, most of our properties have had some sort of value add component. And to those who are on this call who have invested with us, either whether it was Sagebrook or Toscana or currently Republic Deer Creek, at all of those properties we've done a traditional value add, which would be updating the units, and that team of people that we've built to execute that has saved us general contractor costs, and it's allowed us to kind of really deliver what we set out to do. So that's, I think, whenever we talk about executing improvement plans and our kind of in-house management capabilities, that's is highlighted within those traditional and as we'll talk about in more detail, kind of our more innovative value add programs. So.
Thanks. And I want Caesar to come in, but I just want to highlight one thing that Dave didn't touch on, which David deals with on a daily basis. Which when I started the presentation, I spoke about the people within the firm, and a big part of that is managing our the breadth of our management company and our operations and our frontline heroes who are really out there making sure that our communities are solid and that they're operating well and everything. And so Dave has a large task in making sure that everybody basically effectively executes on these plans and does it in a good manner. And I have to say that some of my best moments as CEO is I receive notes from employees or team members who say how well they feel that the operational leadership has been managing certain situations, or just the positive outlook that they've given and just opportunities that they feel that they get. And a lot of that comes from from the operational side. So I just wanted to throw that in there. But Caesar, please, would you like to take the next one?
Yeah, I mean, I just want to chime in. One reason why that attracted me to HLC Equity, because HLC is an owner-operator firm. And to me, this is very important because I sit on the opposite side of the equation, where working in private equity, I work for a firm who do a lot of property management as third-party property manager. And I saw that having a firm that also own and self-manage, they align the interest between the investor and the owner, and they take care of the asset like they own. And also it allowed them to carry out a lot of different ideas, strategy, and innovations. And the PropTech 360 and the layer brand that HLC has built over time also attract me to that, because I've seen firsthand how technology and innovations you can carry that, and also can to increase the value of the asset by either reducing costs or essentially unlock different play within multifamily to increase revenue. And I be able to increase NOI, and return by 100 bips to 200 bips. And the layer brand is what attracted me to that to the firm, because it is a very innovative approach, allow us to provide a very different type of offering to renters that are looking for not just any traditional renter, but also different products, different services. And Dave, if you are, can you talk more about layers? Yeah.
Sure. Yeah.
So
I'm sorry. Go ahead, Dan.
No, we're going to get to layers in the details on layers in a second in the next slide. But I appreciate what you're saying. Thank you, Caesar. And I just wanted, before we get into that, because it is definitely a main component, I wanted to also throw out our firm runs what started as just a kind of get together between prop tech companies, property and technology companies, and now PropTech 360 has become really kind of like an innovation platform within our company, where we're able to cooperate and collaborate with all kinds of different technology companies in order to integrate them in all realms of our kind of ecosystem. And it also has allowed opportunities where we invest either in prop tech funds as LPs, or else directly with the prop tech companies, which we're doing less of today, but that does exist. And so then there's layers, and we're going to get deeper into layers in a moment, I believe. But I think that if we just follow the flywheel, there's also the factor of, obviously, all of this, the goal beyond our purpose, which is to build thriving communities. Obviously, we're focused on also delivering superior returns and to build investor relationships, which we're constantly doing. And thankfully, our track record, since we've been building this in terms of investor returns and returned capital, is it proves it. And for those who are interested, we're happy to expand, and we again could do a whole other webinar on case studies of deals where we've been able to execute on this, both from just a practical property improvement plan to the innovation that we've been driven, and maybe we will do a webinar on that just specifically for that. And then obviously the investments allow us to realize growth and to reinvest, and then we get back into the acquiring. And so that's really kind of the flywheel. And so you guys have heard a little bit about layers, and there's a lot to unpack within layers, but I would love for Dave, who really kind of is the interface on the property with layers, the brand that we build and the operating model that we built to operate these communities, if you could just expand on it a little bit, Dave.
Sure. Yeah. So, layers, as we kind of touched on the last slide, is more of what we would term kind of an innovative value add. We came to layers, the idea of layers a long time ago. We've been working on it for a long time. Daniel, really kind of brought it to my attention shortly after I joined the firm, of this kind of idea of adding services and, a different look at the lease process, that maybe it wasn't as popular at the time, and, a way to kind of add value at the property. And it's evolved since then quite a bit. And I think maybe the best way to, kind of explain it would be to explain some of the challenges that we faced whenever we kind of, implemented and developed it. So whenever we started out on the process with layers, and just to kind of give a little bit of background, layers is a service apartment offering that a traditional renter comes to the apartment, they're staying for 12 months. They are, providing their own furniture, they're, paying for their utilities, etc. With a layer, in our layers program, we call them service apartments. A lot of those items are changed or are included. So the length of lease is much more flexible. It can range from 30 to as long as somebody wants, but as short as 30 days. There's a number of services and costs that a renter would normally experience that are now included in the rent, et cetera. And we charge a premium for that. So that's kind of what a service department is. And whenever we went and attempted to kind of implement this, we kind of saw a number of hurdles. And starting right off the bat with kind of our kind of regulatory and I would say kind of loan agreement restrictions that we came across as we started to implement the program. So every property is located in some sort of city who has various rules regulating hotels, what's a hotel, and we're not hotel operators, we're conventional apartment operators. So we had to kind of make sure that our program is consistent with what is accepted as a kind of a standard conventional multifamily property, while offering this these differentiated services. And then then we also had the loan agreement language that we had to work through. Every of our properties, and our properties are all in excess of 100 units, has a loan agreement behind it, and the loan agreement speaks specifically to lease language and lease lengths, et cetera. And so we had to kind of craft a program that allowed us to offer these shorter term leases with these services that were still remained consistent with the agreements that we had put in place with our lenders. And so those were kind of the initial hurdles that we faced. And then beyond that, once we were kind of able to work through it, we kind of jumped down to the operations at the property level, and adjusting our the way we do things at the property level. So on one sense, a service department is it's something as simple as, hey, you offer a short-term lease, you post it on Airbnb, you rent it for a premium, you put some furniture in there, and it all works out. But really below that, once you scratch beneath the surface, you see there's a lot of policies and processes that need to change. And so at the property level, we looked at our lease agreements, and we modify our lease agreements to kind of make the process more similar to what somebody who's looking for a shorter term stay would expect whenever they're renting. And we looked at our product and said, okay, do we have the right furniture? Do we have the right mix of of services and offerings that help that is going to be appealing to somebody who's looking to only live in a place for maybe a month or up to 6 months. And then we looked at kind of the marketing. How do we reach these people? At the property level, we have normally in a conventional, we have channels of marketing channels that we use that, are well known, but are targeted towards 12-month plus renters. And, we had to adjust our, approach to marketing. And, I mentioned Airbnb earlier, but most of our renters don't come from Airbnb. So we had to develop channels and methods to kind of attract renters. And we currently run this program on 3 different properties. We have about 20 apartments, and our occupancy is in excess of 90%. So we're those marketing channels are important, and keeping that pipeline full is important. And then finally, the hurdle of profitability and making it all work. Whenever we set out to do layers and what I call an innovative value add, the value add is profitability. And our focus has been on making sure that when we're doing this, it is profitable. And, I think, just kind of, I hope that kind of lays out a little bit more about layers and, some of the challenges, and also just kind of our approach to an innovative value add, as opposed to the traditional one that we talked about in-house, where you're kind of updating the apartments and updating the common areas. This is a little bit of a twist, a little bit different. And I think it's, kind of needed in this market. And maybe Caesar can even talk about that a little bit on, how challenging the pricing has got for traditional value adds, and why, we feel like this, our layers gives us a bit of an edge there. So.
Yeah, Caesar, why don't you, what do you think about that?
Yeah, absolutely. So, taking a step back, looking at overall investment for multifamily as an owner operator, in our view, there's 3 levers that we can do to add value to the investor. Obviously, the first one is lower cost of capital. Second one would be operations, how we leverage our infrastructure and our property management team to drive higher return to investor, by increasing revenue of the property via layers or control costs via our property management. Then the last piece would be, identify, opportunity for us to invest in deals and in market where we can benefit from cap rate compressions. However, in this environment, there's a tons of capital sloshing around. Everyone is piling onto multifamily because, in this environment, it's always better to hold on to hard asset that can somewhat counter to the inflation environment. It's very challenging. Our firm has been looking at, we've been focusing a lot on market that have tailwind, to overall investment thesis. And some of the market that we highlight here would be the typical, market that everyone's know of: the Texas market, the Sun Belt, and the Florida market. The reason why we like this market a lot, because looking at the demographic and all the fundamental out there, there's a tons of population growth that help with absorptions. There's a lot of company moving into this market because of very business friendly environment, and they constantly, and also low cost of living and very affordable. That's the reason why we are very bullish on this market. However, as kind of looking forward to the next 5-10 years, we see now that actually this past year is the first time that Texas market and the Sun Belt market, the average rent is actually trend above the national average. Within the last couple of years, the Texas, the Sun Belt market, rent growth has been around 20+ to 30% rent growth over the last couple of years, which is not a sustainable rent growth. So we are constantly thinking about where, think ahead and where we're going to place our bet, so that to find market that we can benefit from population growth, job growth, but still affordable rent, and to be able to find, outsized value for investor. And there's another hidden gem market that we've been looking at quite aggressively in the past, few months to a year, and we'll do another webinar on it, and we're very excited, to show you our thinking. But here I can show you a strategy we've been doing. For example, is this deal called Southgate Apartment in Dallas MSA that we are doing. So this is still within Dallas, a high growth market, but is in the McKinney submarket of Dallas, which is one of the fastest growing big city in US over the last 10 years. We buy this building, is a brand new Class A multifamily, will be delivered in April, and we buy it at CO. We locked in this deal a year ago, while still under construction at sub $200,000 per unit, versus a comparable building today would trade about $250,000 per unit. The reason why we do this because, by taking on locking the deal up front a year ago, we're able to deliver, immediate value to our investor when they invest with us. And that's a strategy that we are looking a lot more lately, going directly off market, talking to the developer, buying building at CO, and taking on the lease up, the leasing arrangement to deliver a higher returns. For this deal, when we stabilize the asset, we look at a 5 cap as a stabilized level, which is a significant spread compared to a Class A multifamily in Dallas today, been trading at a 3.5 cap. So that's immediate value to our investor. And that's something we're going to looking to deploy as a strategy across different market, Texas, Sun Belt market like Atlanta, Charlotte, Nashville, to get higher returns. And here is some of and then this building, here's some of the photos for the property, where because of the quality here, there's also potential for us to implement layers at the property for renters who are looking for more flexible lease arrangement. They want to have higher services to the property. So those are some of the strategies that we're doing now, on top of looking at different market, going to secondary market to get to find better deal and better yield for our investor.
Okay, thanks a lot, Caesar. So that really captures a lot of kind of what has been going on from a market analysis standpoint within our firm. And Caesar sat on a lot of data for a long time, and he's kind of he's an Excel guru, we can call him. I think that's fair to say. And he kind of compressed all the data, and with that came up with some very interesting market data for certain markets. Like we said in this prior one, that hidden gems at the bottom here, you can see some hidden gems that we are kind of targeting in going forward, and there's some specific reasons for it. And the reason why I think that that's also important to note is because throughout the firm's history, there's been kind of a pattern of identifying markets early before other folks are really interested in the market, but they soon become interested. Even if we go back to principals and founders of the firm that invested in places like Scottsdale, Arizona before that anyone knew where that was, to more recent times investing in like Brooklyn, New York in 2012 and 13 before it got extremely hot, and then it became less desirable and the firm got out, to markets like Denver, Colorado before it became extremely hot, and including a main focus market for us now, Dallas, where we started investing there in 2014, 2015. And now it's a highly desirable place. And there's other markets along the way that we have kind of used both data and also hopefully some good intuition to identify, and we've executed on those deals, and thankfully the current ones are going very well. So I think that from where we take both a data-driven approach and also just an approach in terms of trying to view intuitively where there's going to be growth. So I think that that's really important. So now we'll just go in terms of, we kind of sat around and we said, hey, where are some, for those who are participating, our investors and potential partners and whoever it may be, who just want to learn, about real estate, maybe wanting to build your own firm or not build your own firm, and to invest alongside our firm or other firms. So kind of just thinking about building towards a legacy from a multi-generational firm. So here are just some key takeaways that we would like to share. I think, obviously it's very important to understand your values and that there always be an alignment of interest. So for us, there's many alignment of interest, and one of the main ones is that we approach everything from an investment standpoint, and we have what's referred to as skin in the game in terms of our own co-investment in every deal. Having a long-term outlook, like we said before, that goes with values, that goes with relationships, and it also goes with investments. Needs to be assets that you feel you're going to be able to own and they'll do well for a very long period of time. Owning high quality assets, especially in this market, where there's a lot of questions, and things could go both ways. Honestly, they could go head for the worse or head for even better, and we really don't know. So we want to own high quality assets, in such an uncertain time. A focus on innovation. Where can we innovate within our business models and within this business, which is an established business. But every established business also needs innovation, and we prefer to be ahead of the game and to be innovating than to be innovated on. Develop operational excellence and cost controls, which is a lot of what Dave works on and what he discussed. And again, Caesar mentioned that he saw that as a benefit from other firms that he worked with that either did have that or didn't have that, and so he felt that was something important in terms of heading towards a legacy. And then exercise prudent financing, with transactions is extremely important. And then to perform efficient due diligence and market analysis is also always key. And those are areas in which we're really focused and where we're really trying to to find value and to provide value and to continue doing so. So I'm going to go now to a little Q&A. And happy to, if anybody wants to write in here on the chat, I believe that we should be able to see it. Just a moment here. Okay, we have a couple questions coming in, and please feel free to write into the chat. And if we are not, okay, there we go, more. If we're not able to get to all of these questions, we will definitely touch upon them. We're available and we can be reached. So let me just try and go through these. Okay. So the first question is, you've been able to make the layers model operationally efficient. What can us as smaller investors / operators who may not have the infrastructure like HLC do to push innovation forward in our own investments? So So Dave, do you want to touch on that? Basically, asking there's a group here, they want to, they're smaller group, less established, but trying to get established, and they want to know kind of what are some initial steps they could take to innovating within their own operations and investments.
Sure. Yeah. I mean, just I don't know when it comes to innovation if being a smaller operation is really a disadvantage. Innovation is really about implementing ideas. So from our perspective, what we're doing, which I think would apply to kind of businesses of any size, would be we're looking for trends and in society or macro trends and demands from the marketplace where you're trying to meet them. And I think a couple of these are not anything that no one's that are secrets or anything, is like you have trends towards working at home right now. So if you are a smaller operator, you have a few units or even 10 or 15, how are you targeting, how are you customizing your offerings to meet that rental demand? Or we have energy costs are going up, other costs are going up. What are your thoughts on how are you protecting your asset there? I mean, are you entering into long-term fixed rate energy contracts? I mean, those are available even at a smaller level, even at the residential level. Are there things you're doing to protect yourself and to so that you kind of separate yourself from the competition? And that's really innovation. It can take many forms, and those are just some thoughts. But I don't necessarily think that being a smaller operator would prohibit you from innovating.
Okay, very good, thank you. Okay, the next question that came in here is relates to interest rates, and it's got a lot to it, and I think that it's something that's on everyone's mind, and it's an important question, and so I'm just going to kind of rephrase it here so that we can deal with it. But basically, the question is just going over historically when you look at even between 2004 and 2006 and the rise of interest rates, and thinking today and the potential that that the Fed is saying that they will raise rates, even though they've said it before, frankly, but they very well may, and it wouldn't be surprising if they do. So kind of thinking, how could that impact values? How could that impact real estate? Do we think rents will go up? So just generally trying to get our thoughts on that. Caesar, I think that would be interesting for you to answer.
Yeah. So interest rate is something that constantly on top of my mind. Overall on the investment side and acquisitions, a lot of group out there, with the low interest rate environment we've seen over the last decade, really drove up the value of asset across the board, especially with multifamily. And multifamily is an asset that somewhat inflation protected, because you as an owner, you can raise rent, but there's to a certain extent that you can raise rent to the only when is affordable for residents. So but with now we've been talking about interest rate raising for many years now, and we finally is here. And for us, actually, this actually is a challenge, but it presents an opportunity for us as a team, as a firm, because over the last few years, it's been very difficult to win deals because everyone else has been very aggressive on bidding on deals because they benefit from low interest rate, and they use credit financing, like from getting floating rate debt from debt fund to purchase, to allow them to leverage up the deal to get the returns. For us as a firm, we actually never have done that. We always do low leverage deal, long-term fixed rate debt, to make sure that we, to shield from the fluctuation of interest rate movement. We typically invest deal between 60 to 70% lever, on the low end, most of the time 60 to 65. And now actually with the interest rate going up, a lot of these buyers are now falling through, and actually present us an interesting opportunity to come in and also be able to compete. So I'm actually quite excited in this environment that I'm no longer losing, 100, 200 deals, I'm able to have a fighting chance. Yeah, so that's my thought.
Okay, great, thanks. The next question here is, does your company ever deal with situations where investors want to pull their capital out of a deal early, and how does that affect the investment as a whole? So if I understand, it's asking, like if somebody comes into an investment, let's say in 2019, and then in 2020, they said, hey guys, this is great, but I would really like my capital, to go invest in something else, or to buy a house, or whatever it may be. So the quick answer is, that generally doesn't happen. There is talk about secondary markets for these types of offerings, but as it is today, when we go in, first of all, our overall outlook plays into kind of those initial slides, which is that the long-term approach to real estate, is really just the better approach, and we've seen it over a 70 year track record in history. I haven't seen it for the 70 years, but I've been able to look at the numbers and the books, and you can just see when you hold on and you either refinance or you exchange in other properties and you keep it in properties, generally you benefit. So there is, we don't have a mechanism necessarily for people to get out of investments early. Now, with that said, we have done investments where we thought it was going to be a 6-year investment, and because of certain factors within the market, maybe the market shifted, or else we pulled off a capital improvement plan really quickly, we've sold it within 2 years, right? In return investor capital at high 20+ IRR, with 2+ multiples and so forth on investor returns. So it's not that it hasn't happened, that it's been closer or quicker than the horizon, but in general, if everybody is in the deal, then people don't get out of the deal early. And just my own personal philosophy and advice would be to stay in real estate. for a long period of time, and to witness what happens when you get the tax benefits and you are able to refinance and pull cash out, without tax penalties and so on and so forth. So that's kind of how we view it. Moving on here. Okay, so there's a question here. Are there any plans to white label the layers model? It sounds like it's far from more than just some furniture and an Airbnb listing. Dave, you want to take that?
Yeah, sure. Yeah, I can speak to that. There's, yeah, I guess the answer is absolutely. We have a program we call Layers Light that we are actively working with some outside property owners to kind of implement on their properties, and we have plans to expand that considerably. It is a model that we can kind of work with other groups to kind of run on their properties, and so I think the short answer is yes. There's certainly opportunity there.
Yeah. And I'll just mention that, that is something that in 2022 we're pushing. And so, for any of the owners and operators out there of multifamily assets, we, have something available, and we'd be happy to speak and to basically show how we benefited from it, and to get premiums on your properties if it's a suitable property. So happy if anybody wants to get more information on that, please feel free to reach out. Let's see. So there's one question here. Speaking of innovation, any consideration of a fund? It gives us investors a way to buy into the long-term vision and leadership. So we definitely have lots of discussions, and people have asked several times if we're going to be launching a fund. Right now, we currently are not. That doesn't mean we won't in the near future. But I don't have, a fund that I can speak to right now. We do have very interesting deals, one of which was Southgate, that can be invested into. And we, in the future, we definitely do see that a fund is probably in the horizon, just because we have been investors have requested. But right now, it's mainly doing it on a deal by deal. Okay. Let's see. Well, there was a question here about that we seem bullish on Texas based on our recent investments and our other regions that are trending in the same manner. And is that reflected in the pipeline? So the quick question is, yes, there are other areas that we feel that there's growth. Caesar touched upon it. We're going to do hopefully a more in-depth webinar on the market analysis and some of the hidden gems, as we call them, and in which we're happy to share where we're targeting which markets. But there definitely are more markets, but it goes after the overall fundamental of finding it, where is the growth, where does pricing make some sort of sense, and where can we find yield. And so there are certain markets that we've identified that we feel that we in this current environment will have luck basically finding those opportunities. There's a question here about return expectations going forward. What should the return expectations in terms of investments going forward? Should they be higher or should they be lower? It's hard, our expectations for the last 5 years have always been, that it's been lower because cap rates have been lower. And generally, when cap rates are lower, that's a reflection of yields. And so we always felt that the expectations need to be lower. And so we've gone, over the last 5 years with very conservative underwriting. The results have actually been much higher than we predicted. So, I think though that there is a real need for investors to, despite the current volatility with, the unfortunate war that's going on in a bunch of different other items that are kind of messing with the economy within the last month. But even if we look at the last year to two, there's a big need to really adjust expectations when it comes to returns and to be much more realistic. We see a lot of numbers flying all over the place, and I can, or anybody can make a model, an Excel model look really exciting and fancy. But I think that what's more important is probably the background of the group, the people you're investing in, and the people that you're investing with, because at the end of the day, deals can be great and they can be not so great. And when they become not so great, you want to know that the group that's behind it is really acting appropriately and doing the right thing for everybody. Okay, let's see, maybe just one more question here. Okay, well, this kind of plays into what I just said, but HLC Equity seems to be in the unique position to see both sides of the investing spectrum, from passive and active. What type of investor would invest passively in an offering versus to go out on your own? And so it's interesting because we get this question a lot in terms of, should I go buy, a duplex or a fourplex or something like that on our own, versus should we invest, with HLC Equity or any of the other groups that are out there that we could invest with? And it really just depends on the goals. But I can say that in real estate and in real estate investing, scale matters. And so, if you own a fourplex and a pipe breaks, it's a huge deal. If you own 250 units and a pipe breaks, it's still not pleasant, but it can be managed. And there's lots of different items like that where you see that scale really is helpful. And so, most investors who invest with us, they realize that we have created the system and the management that allows to manage these for people. And it's funny because one of our investors who just invested in the Southgate deal, when he's a very busy professional, and when he signed the subscription agreement and I was speaking with him, he said, "This is great. I mean, I just signed these documents, I put in I wire the funds, and you guys deal with everything." So that's kind of the goal of what we've built. So obviously, and I can also say, as a passive investor in other people's deals, it's also pleasant to be able to say, I personally invest in other people's deals that don't do exactly what we're doing or do a different asset class, and it's nice. I don't have to deal with anything. I don't have to think about anything except for just making sure that I get my check and I get my tax documents at the end of the year. So that's how we view it. Would Caesar or Dave, I think that we're good with the Q&A. Do you guys want to say anything else with everything that was said here? Any other comments?
Nothing really. I just would just say, I think the questions were great, and appreciate having a chance to opportunity to speak with everybody and our ideas. And if there's follow-up questions on from the operation side or any side, feel free to reach out directly. I think Daniel's putting up the contact information below, and we could certainly follow up with anybody with more specific questions or concerns.
Yeah, definitely. Caesar, you have anything to close with?
Yeah, so thanks so much everyone for making the time to listen to us. One thing I would like to kind of relay is that yes, in real estate is a great asset class to invest in, and deals are great, but at the end of the day is the sponsor who you're investing with, because at the end it's a partnership, and investing with the right sponsor is the key, because deal with the right sponsor, they will find the right deal, they will manage and take care of the asset for you as an investor. So with that, if you have any questions and any ideas about acquisition, looking at deals, I'm more than happy to jump on phone and chat. Always look forward to hearing different perspective on deals and markets.
Okay, great. Well, thank you very much, and really appreciate everybody's time. And again, this is the first of what we hope to be a series, and we'll dive into some of these topics that we just kind of brushed upon and gave an overview. But thank you very much, everybody. We appreciate your time, and we hope you have a great and wonderful rest of your day.